You're broke because you're lazy. I don't care if that offends you. I care about making you rich. And right now in 2026, you're sitting on the sidelines while two specific ETFs are quietly positioning themselves to double investor money, and you're doing nothing about it. That's the biggest mistake of your financial life. I'm Kevin O'Leary. I've built companies worth hundreds of millions. I've negotiated deals that would make your head spin. And I don't deal in hope or hype. I deal in cold, hard data and returns. And the data right now is screaming one thing. Two ETFs are positioned better than anything else in the market to deliver outsized returns this year. But before I tell you which ones and why, you need to understand the fundamental shift happening in global markets that most investors are completely blind to. Because if you miss this, you'll watch everyone else get wealthy while you stay exactly where you are. Let me be brutally honest with you. Most financial advice you're getting is garbage. It's recycled wisdom from people who've never actually built wealth. They tell you to diversify into 20 different funds, hold forever, and pray. That's not investing. That's financial mediocrity dressed up as prudence. I've spent 40 years in the trenches of business and investing. I've made fortunes. I've lost fortunes. And I've learned one unshakable truth. Concentrated bets on the right vehicles at the right time create generational wealth. Diversification is what you do when you don't know what you're doing. Now, I'm not telling you to bet your entire net worth on two positions, but I am telling you that in 2026, there are two specific ETF opportunities that represent asymmetric risk-reward profiles that we rarely see. And if you understand why these two funds are positioned the way they are, you can make informed decisions that could legitimately double your investment by the end of this year or early next year. Here's what makes this different from every other talking head telling you about hot stocks. I'm going to walk you through the actual structural reasons these ETFs are set up to win. The macroeconomic tailwinds, the sector rotations already happening beneath the surface, the technical setups, and most importantly, the risk management strategies you need to implement so you don't blow yourself up chasing returns. Because here's the thing nobody tells you. Every massive return comes with massive risk. And the difference between smart investors and gamblers is understanding exactly what you're risking and having a plan when things don't go your way. I'm going to give you both sides, the bull case and the bear case. And then you can make your own decision like an adult. Let's talk about where we are right now in the market cycle. Because context is everything. We're in one of the most unusual economic environments I've seen in my entire career. You've got central banks that have been tightening for years. You've got inflation that's been persistent but starting to crack. You've got unemployment that's remained surprisingly resilient. And you've got asset prices that have defied gravity. Traditional models say this shouldn't work. When rates go up, asset prices should come down. That's basic finance. But we're not in a traditional cycle. We're in a technology-driven, AI-accelerated, demographic-shifting, deglobalization cycle that's rewriting all the rules. And here's what that means for you as an investor. The old correlations don't work anymore. The old diversification strategies don't protect you the way they used to. A 60-40 portfolio of stocks and bonds got destroyed in 2022. Destroyed, because when everything moves together, diversification is an illusion. So what works now? Thematic concentration. You need to identify the secular trends that are going to dominate the next 3 to 5 years and overweight your portfolio toward those trends. Not gamble, not speculate, but make informed, concentrated bets on structural shifts that are already in motion. The two ETFs I'm about to reveal to you are perfectly positioned at the intersection of multiple secular trends: technology adoption, energy transition, artificial intelligence infrastructure, semiconductor dominance. These aren't speculative themes. These are trillion-dollar build-outs that are happening right now, whether you pay attention or not. And here's the beautiful part. While everyone's been freaking out about market volatility, about geopolitical risk, about recession fears, institutional money has been quietly rotating into these exact positions. You can see it in the fund flows. You can see it in the options activity. You can see it in the insider buying. The smart money is already positioned. The question is, are you going to follow or are you going to sit on the sidelines and watch? Now, I want to be clear about something. These aren't penny stocks. These aren't crypto moonshots. These are legitimate, liquid, institutional-grade exchange-traded funds with billions in assets under management. But they're positioned in sectors that are about to experience explosive growth. And that combination, liquidity plus growth, is where you make real money without taking stupid risk. All right, let's get into the first ETF, and I want you to pay very close attention because the devil is in the details. The first fund you need to understand is a semiconductor-focused ETF. Now, before you roll your eyes and say semiconductors have already had their run, shut up and listen. Because what's about to happen in semiconductors over the next 18 months is completely different from what happened in the past 3 years. The semiconductor rally from 2020 to 2023 was about supply chain recovery and pandemic demand. That's over. Done. What's happening now is structural. We are in the early innings of the artificial intelligence infrastructure build-out. And I'm not talking about ChatGPT on your phone. I'm talking about hundreds of billions of dollars being spent on data centers, on AI chips, on high bandwidth memory, on advanced packaging, on everything that makes AI actually work at scale. And here's the key insight most people miss. The AI infrastructure spending cycle is at least a 5-year cycle, probably longer. We're in year two. That means we've got 3 to 4 more years of accelerating capital expenditure from Microsoft, from Amazon, from Google, from Meta, from every enterprise company on earth that's trying to stay competitive. The specific semiconductor ETF I'm talking about has concentrated exposure to the companies that are the picks and shovels of this build-out. I'm talking about the companies that make the actual AI accelerators, the companies that manufacture the chips, the companies that provide the design tools, the companies that supply the materials. This isn't a broad tech bet. This is a surgical strike on the supply chain that has no alternative. Now let's talk numbers. Over the past 12 months, this ETF is up, but it's actually underperformed the broader market recently because there's been rotation out of tech into other sectors. That's created a buying opportunity. The valuation multiples have compressed. The forward PE ratios are actually reasonable compared to the growth rates we're looking at. And the technical setup shows we're building a base right here, right now for the next leg higher. Here's my price target thesis. Based on the earnings growth estimates for the underlying holdings, based on the capital expenditure commitments we're already seeing from the hyperscalers, based on the adoption curves for AI across enterprise, this ETF should trade at a significant premium to where it is today. I'm talking about a potential double from current levels over the next 12 to 18 months. That's not a guarantee. That's a probability-weighted scenario based on fundamental analysis. But here's the risk. And you need to understand this. If we go into a recession, if AI spending gets cut, if there's a geopolitical event that disrupts the semiconductor supply chain, this ETF will get crushed. It's a high beta play. When the market goes down, this goes down more. That's the trade-off for the upside. So you need to position size appropriately. You need to have stop losses. You need to have a plan. My recommendation? If you're building a position, do it in tranches. Don't go all in at once. Buy a third now. Buy another third if we get a pullback. Buy the final third if we break out to new highs. That way you're averaging in and you're not trying to time the perfect entry, because timing the market is impossible. But building a position methodically over time in a secular growth trend is how you actually build wealth. And one more thing, this isn't a set it and forget it investment. You need to monitor the quarterly earnings from the major holdings. You need to watch the capital expenditure guidance from the big tech companies. You need to stay informed, because if the thesis breaks, if the data changes, you need to be willing to exit. Being wrong is not the problem. Staying wrong is the problem. Now let's talk about the second ETF. And this one is probably going to surprise you because it's not in tech. It's in energy. Specifically, it's a clean energy and energy transition ETF. And before you start screaming about politics or subsidies or Elon Musk, let me explain why this is a money-making opportunity regardless of your personal beliefs. Here's the reality. The world needs to double its electricity generation over the next 20 years. Double it. You've got electrification of transportation, you've got electrification of heating, you've got data centers sucking up power like there's no tomorrow, you've got developing nations industrializing. The demand for electricity is going exponential. That's not an opinion, that's physics and economics. Now, where's that electricity going to come from? It's going to come from a mix of sources: natural gas, nuclear, renewables, everything. But the fastest growing segment by far is renewable energy. Solar and wind are now the cheapest forms of new electricity generation in most parts of the world. Not because of subsidies, because of technology improvement and scale. The cost curves have come down so dramatically that renewables are now economically superior in most markets. And that's creating a multi-trillion-dollar investment cycle. You've got utilities building out massive solar and wind farms. You've got corporations signing power purchase agreements for renewable energy. You've got governments mandating renewable targets. You've got the entire grid infrastructure being rebuilt to handle distributed generation. This is a structural shift that's going to play out over decades. The ETF I'm talking about has exposure across the entire value chain: solar manufacturers, wind turbine companies, battery storage, grid infrastructure, electric vehicle charging, energy management software. It's a diversified basket that captures the entire theme without betting on any single company. And that's actually a smart way to play this, because picking individual winners in emerging industries is really hard. But investing in the entire wave is much easier. Now, here's why this is a 2026 opportunity specifically. Over the past 2 years, clean energy stocks got hammered, they got destroyed, interest rates went up, which hurt the financing for these capital-intensive projects. There was political uncertainty, there was supply chain disruption. The whole sector got sold off indiscriminately. This ETF is down significantly from its 2021 highs. But here's what's changed. Interest rates are stabilizing and likely coming down. Project economics are improving. Supply chains are normalizing. And most importantly, the actual deployment of renewable energy is accelerating regardless of the stock prices. You've got record installations happening right now, record capacity being added. The fundamentals are screaming by while the sentiment is still negative. This is exactly the kind of setup I love. Hated sector, bombed out prices, improving fundamentals, clear secular tailwind. That's where you make outsized returns, not chasing what's already gone up, but buying what's been left for dead that's about to come back to life. My thesis is simple. As we move through 2026 and into 2027, money is going to rotate back into clean energy because the returns are going to become impossible to ignore. You're going to see earnings growth accelerate. You're going to see margins expand. You're going to see these companies generate actual cash flow. And the stocks are going to re-rate significantly higher. Could this ETF double? Absolutely. It's trading at a massive discount to its historical valuation. It's trading below its net asset value in some cases. If we just get back to normal valuation multiples without even assuming multiple expansion, you're looking at a double. And if we get any kind of enthusiasm back in the sector, you could see even more. But again, let's talk about risk. If interest rates spike again, this trade doesn't work. If there's a global recession and infrastructure spending gets cut, this trade doesn't work. If there's a major policy reversal on clean energy incentives, this trade gets hurt. You need to understand what could go wrong. My positioning advice is similar to the first ETF. Build your position over time. Don't go all in. Use any weakness as a buying opportunity and set yourself a time horizon. This is not a 1-month trade. This is a 12 to 24-month position. You need patience. But if you have patience and you let this thesis play out, the returns could be spectacular. All right, let's talk about how you actually implement this, because having good ideas means nothing if you execute poorly. And most retail investors have terrible execution. They buy at the top, they panic sell at the bottom, they over-leverage, they don't have a plan. Don't be that person. First, position sizing. These 2 ETFs should not be your entire portfolio. I don't care how convicted you are. I don't care how much you believe in the thesis. Never put more than you can afford to lose in any single position. My rule of thumb, no more than 10 to 15% of your portfolio in each position. That gives you meaningful exposure without blowing yourself up if you're wrong. Second, entry strategy, dollar cost average. I've said this already, but I'm going to say it again because it's critical. Split your intended investment into 3 or 4 purchases over the next few months. That smooths out your entry price and removes the pressure of trying to time the perfect moment. Markets are volatile. You're going to second guess yourself if you go all in at once. Third, stop losses. You need to decide in advance what price level means the thesis is broken and you're getting out. For me, on ETF positions like this, I typically use a 15 to 20% stop loss from my entry price. That gives the position room to breathe, but protects me from catastrophic losses if something fundamentally changes. Fourth, profit targets. You also need to know when you're going to take profits. If these positions double, are you going to sell the whole thing, sell half, and let the rest run? Have a plan before you're in profit, because emotions will cloud your judgment when you're sitting on big gains. Fifth, rebalancing. Check these positions quarterly. Look at the fundamentals. Are the underlying companies still executing? Is the macroeconomic environment still supportive? Is the technical picture still healthy? If yes, hold. If no, adjust or exit. And finally, tax efficiency. If you're in a taxable account, be mindful of short-term versus long-term capital gains. If you can hold for more than a year, the tax treatment is significantly better. Plan your holding period accordingly unless the thesis breaks earlier. This is not complicated, but it requires discipline. And discipline is what separates winning investors from losing investors over the long term. Look, I've given you everything: the market context, the specific ETFs, the fundamental thesis, the risk factors, the execution strategy, everything you need to make an informed decision. Now it's on you to actually do something with this information. Most people will watch this video, think it's interesting, and then do absolutely nothing. They'll go back to their mediocre portfolios and wonder why they're not getting ahead. Don't be most people. Take action. Do your own research. Look at these ETFs. Understand the holdings, read the prospectuses, and then make a decision like an adult who's responsible for their own financial future. These two ETFs have the potential to double your money in 2026, not because I'm a genius, but because the structural trends are in place, the valuations are reasonable, and the risk-reward is asymmetric. That's rare. When you see opportunities like this, you need to act. So here's what you do next. Open your brokerage account, look up these funds, start building positions, implement the risk management strategies I gave you, and then sit back and let the market do its work. Wealth is built by making smart decisions and having the patience to let them compound over time. I'm Kevin O'Leary. I don't waste your time. I don't sugarcoat. I give you the truth. And the truth is, if you execute on what I've just told you, you'll be in a significantly better financial position 12 months from now. Now go make it happen.